You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu.
Hey, what's up, Market Moose? Mike from the Moose on the Loose. How are you doing on La Saint-Jean-Baptiste? So, bonne Saint-Jean to all my francophone Quebecois listeners. So today, we do have a special episode. Unfortunately, I'm not going to do it in French because I want you all to listen to this one. But I thought of doing a quick exercise of talking about my favorite companies based or coming from Quebec. And actually, there are a lot of great dividend growers out there. I was kind of surprised doing this. So I'm not going to list all of those, but I just want to highlight a few of them. So let's get started with Richelieu Hardware. This one had it tough over the past few years. So the stock price since the big hype of COVID, so since 2022, has been on the down low, but maybe it's going to bounce back. So Richelieu Hardware, the thing that I really like about it is they are distributing, importing, manufacturing all the specialty hardware in Canada and the United States. Most of the things that you can find in your kitchen, in your bathroom, like the cabinets and stuff, like the screws and the bolts and all of those like small stuff, they're making those. So they are distributing over 100,000 products, and most of the time you're gonna find their products into the Ronas, the Home Depots, the Lowe's of this world. So doing pretty well, pretty steady business. The revenue is growing most of the time steadily. It's a bit cyclical, but not that much. What hurt a lot over the past few years is the earnings per share. That went from like the peak of 2022 around like $3. Now we're like slightly above 150, and that reflects also on the dividend trend. So from time to time they increase the dividend, not all the time. So it's kind of like, when the economy is booming, this company is doing great. Right now, not that much, but still should put it on your radar. Take a look at it, see how it goes. Another small cap that I want to highlight that is based in Quebec, Savaria. Savaria, ticker SIS.TO. And I'm going to put all the tickers in the show notes as well, so it's going to be easier for you. This one is actually kind of like operating and offering like all the products that helps people getting accessibility, if we can put it that way. So we're talking about anyone who is like physically challenged or has like reduced mobility because they're like getting older, or for an handicap, for example. Well, they are offering like elevators, modification of like stair lifts and stuff like that, or working on your car to make it more like accessible. So it's an interesting niche, but as population is growing, the need for that is growing as well. The company is growing a lot through acquisition, and because it's a small cap, sometimes it will get into more debt to finance their acquisition. But overall, I mean, the dividend triangle over the past 5 years looks kind of interesting. So the dividend keeps on increasing. They have like a longer pause between 22 and the end of 24. So more than 12 months with no dividend increase. So 23 to 24. However, if you look like annualized growth rate, it's still positive, about like 4% per year. So for a small cap, that's pretty cool. The revenue and earnings are also going up. So this one could be an interesting one. Again, with the small cap, you always have to be careful. This is more volatile than a lot of those companies. When they issue shares to finance acquisition, it could hurt as well. So just keep that in mind. Next one on my list, a new position in my portfolio. I mean, not much, but still I was starting to be quite interesting about CGI. So, and it's interesting because the ticker is GIB.A.TO. This is an IT service company. a lot of it is like with subscription. They have a lot of government contracts, so the company is like very stable, operating in like 40 countries, 90 employees. And what I like about it is, yes, it's not a super fast growing business, but the revenue and the earnings are growing constantly. And this is usually when you have like when you operate a solid software as a business and like subscription based business in the tech world. This is what it looks like. So the revenue over the past 5 years has grown by 4% per year, but the earnings per share is at 10. So the company is always incredibly stable and profitable, and they keep most of their clients kind of like forever. So that's another plus on this one. Just started to pay a dividend, so I'm pretty sure it will show a low yield, high growth type of profile. So very excited to follow this new one on my list going forward. Then we have three more I want to talk about. Of course, now we're going to get into like the big names that I love. So first one, Alimentation Couche-Tard. Of course, I mean, founded in Laval. Just love it. ATD.TO. Convenience store. A lot of people are just like, yeah, what's the future of the convenience stores? Since 2024, and we had like a few bad quarters. We had the story about like acquiring 7-Eleven. So since then, the stock price has been slightly going down. So the peak were around like $85. Now we're like pretty much trading around $70. I see this as an opportunity. Like that's my point of view. It's not like advice or anything. I'm not recommending it either. You have to do your due diligence. But yeah, so earnings has slowed down a little bit. That explains why the stock price has reduced. So the company is pretty much trading at the same P ratio. So we have a forward P ratio of 17.5. The average over the past 5 years is at 17.1. So there's not a huge deal here, but knowing that right now there's no hype around the stock, it's actually quite the opposite. That could be an interesting play. I've did a similar play in 2021 when there was no level around the stock. That lasted about a year, and then after that it was like just like a big skyrocketing ships for a while. Not saying it's going to be the same thing, but definitely Alimentation Couche-Tard has everything. They have like a strong management team, they have a strong brand, and incredibly strong playbook to grow through acquisition, grow organically. So it will be interesting to see how it goes moving forward. Next one on the list, of course, National Bank, La Banque Nationale, NA.TO. My favorite bank for the past 22 years. Full disclaimer, 22 years ago, I started working for National Bank. So I worked there for about 13 years. Still a proud shareholder. The company is not just about I work there, though. When you look at the numbers, the company shows the strongest dividend triangle. So strongest revenue growth, strongest earnings growth, and strongest dividend growth over the past 5 and 10 years. So it's not surprising that the stock price, that the stock return is also offering one of the best one among the big six. The recent acquisition of a Canadian Western Bank will open the doors to Western Canada, will open the doors to more cross-selling opportunities across their different services. I like how the bank is able to grow and still pay a nice dividend. And on top of that, they show the lowest payout ratios among the big six. So a great combination of stability and growth, which is kind of rare when you look at companies. So this one definitely a great candidate for any portfolio. And the last one, and certainly not the least, I have also a very small position on this one, Dollarama. Dollarama, ticker DOL.TO. I was skeptical for a while, to be honest. The reason why is I was like, okay, so perfect dividend triangle, revenue, earnings, dividend, everything grows double digit over the past 5 years. So, I mean, you cannot find something that is growing faster than this right now in the retail business for sure. Great growth by acquisition and also great organic growth. So the comparable growth is usually 3, 4, 5%, which is impressive. They open new stores, and then as of late, they started to grow through acquisition. So they have a major stake in Dollar City. So Dollar City is opening stores in Mexico and Central America, and now they are in the process of acquiring the Reject Shop in Australia, trying to go with the similar playbook. So I like this growth opportunity. I was skeptical in a sense where I thought, well, there's so many stores you can build at one point, and then you're just going to hit more Walmarts or Costco's of this world that are going to compete with them. But now with this interesting growth by acquisition strategy, and they still find ways to keep on growing in Canada. So very impressed about how they make it. They sell a lot of their own products. That helps a lot to maintain very high margin. And they have about 5,000 SKUs. So they focus on like a small number of amount of items, and definitely their playbook is working well. So there you go. So they're in no particular order. Today we have covered Richelieu Hardware, RCH.TO, Savaria, SIS.TO, CGI. So the ticker is GIB.A.TO, Alimentation Couche-Tard, ATD.TO, National Bank, NA.TO, and finally Dollarama, DOL.TO. I'm going to put all the tickers anyways in the show description note. I hope that you have enjoyed this one. Happy Saint Jean-Baptiste. I'm going to do a special for Canadian stocks next week. Don't worry about that, Moose. But until then, we're going to talk tomorrow. And don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to the Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy this show and do your due diligence after it.